In March of 2021, one man lost $20 billion. In 2 days. He wasn't a gambler. He wasn't reckless. He was a tiger cub trained by one of the best investors alive. So how did Bill Hwang vaporize a fortune bigger than the GDP of Iceland in 48 hours? One word. Leverage. Charlie Munger once said there are 3 ways a smart person can go broke: liquor, ladies, and leverage. And he wasn't joking. Because leverage is the one mistake that doesn't just hurt you, it erases you. Today, you'll see how the smartest people on Wall Street, people with Nobel Prizes and decades of experience, got destroyed by it. And by the end, you'll know the exact rule that keeps disciplined investors out of these graveyards. Let's start with the math. Because most investors think they understand leverage. They don't. Imagine you have $10,000. You buy a stock. It goes up 10%. You make $1,000. Simple, right? Now imagine you borrow $90,000 more. You buy $100,000 of the same stock. It goes up 10%. You make $10,000. You doubled your money. Sounds incredible. Until the stock drops 10%. Now you've lost $10,000 on a $100,000 position. Your entire $10,000. Gone. The stock didn't crash. It barely moved. But you're wiped out. That's the trap. Leverage doesn't change your average return. It changes your survival rate. And here's where it gets really uncomfortable. In 1994, a group of the smartest minds on Wall Street started a hedge fund. 2 of them, Myron Scholes and Robert Merton, would later win the Nobel Prize in economics. Their fund? Long-term capital management. For 4 years, they were untouchable. They returned 43% in their first year. 41% the next. Investors begged to get in. The fund grew to $129 billion in assets, built on just under $5 billion in actual equity. Do the math. They were leveraged roughly 25 to 1. But that was just the visible leverage. Counting derivatives, their effective exposure was over $1 trillion. Then came August 1998. Russia defaulted on its debt. Markets panicked. The trades that LTCM was sure couldn't lose money started losing money. All at once. In 4 months, they lost $4.6 billion. The Federal Reserve had to organize a rescue to prevent the entire global financial system from seizing up. 2 Nobel laureates. Decades of trading experience. Mathematical models that had never failed. None of it mattered. Leverage doesn't care how smart you are. But here's what most people don't realize: they didn't learn the lesson. Bill Hwang was a protege of Julian Robertson, one of the greatest hedge fund managers in history. He started his family office, Archegos, with about $200 million. Through total return swaps, basically borrowed exposure he didn't have to disclose, Hwang built a position worth over $100 billion. On companies like Viacom-CBS, Discovery, and several Chinese tech stocks. For a while, it worked. By March 2021, Hwang's net worth was estimated at over $35 billion. He was, on paper, one of the richest men in the world. Almost no one had heard of him. Then Viacom-CBS issued new shares. The stock fell. The banks called for more collateral. Hwang couldn't pay. In 2 days, he was forced to liquidate. $20 billion evaporated. Credit Suisse alone lost $5.5 billion. Nomura lost $2.9 billion. Hwang himself? He went from billionaire to broke. To indicted. The same trap. 23 years later. A different name. A different decade. The exact same mistake. So what do the great investors do differently? Warren Buffett has built nearly $900 billion at Berkshire Hathaway. And he's done it with almost no traditional leverage. In his 1989 letter to shareholders, Buffett wrote that he had seen more people fail because of leverage than for any other reason. He's repeated it for decades. Munger said it more bluntly: if you're smart, you don't need leverage. If you're dumb, you shouldn't be using it. Now, Buffett does use one form of leverage: insurance float. The premiums paid to Berkshire's insurance companies that he can invest before claims come due. But that's not borrowed money in the traditional sense. It has no margin call. It can't be yanked away in a panic. That's the key distinction. Buffett uses leverage that can never be forced from him. Hwang and LTCM used leverage that could be and was yanked at the worst possible moment. Because in the end, markets don't kill you. Forced selling does. Here's the principle worth remembering. Leverage is a magnifier. It makes good decisions great, and bad decisions fatal. The problem isn't the upside. It's that the downside isn't a loss, it's an ending. Graham said it best. The investor's chief problem, and even his worst enemy, is likely to be himself. Add leverage to that enemy, and you don't get a setback. You get a funeral. The greatest investors in history compound for 50, 60, 70 years. They survive. That's the whole game. And you can't compound from zero. So here's my question for you. Have you ever used margin or leverage in your investing? What did it teach you? Drop your story in the comments. The lessons we share with each other are worth more than any book. If this changed how you think about risk, hit subscribe. Tomorrow, we're looking at one of the most misunderstood numbers on every balance sheet, and why 90% of retail investors get it completely wrong. This is educational content, not financial advice. Always do your own research.